Let me bring in Keith Fitz-Gerald, Fitz-Gerald Group Principal. He's joining us now on the phone. Keith, good to see you. I'm looking at some of your picks. Apple, Microsoft, NVIDIA. I mean, NVIDIA, Keith, it's up 89% this year. Please tell me you bought it a lot lower than that.
I did. I hate it when that happens. You know, it's very tough business, and we were very fortunate to get in at the right time. I mean, I've been buying throughout most of the decline, a little bit here and there. So, you know, this is great to see because all of the capital is coming back to the marketplace. People are figuring out the contagion they thought wasn't. So, yes, there's still speed bumps. Yes, there's still challenges, but tech is going to go right back to the head of the class because it's one of the greatest single investing trends of our lifetime.
But where do we go, Keith, beyond tech? I mean, you look at the advanced decline line, and it is widening. So, where should you be invested in this market?
Well, to me, it's common sense. You know, what can we not live without? We cannot live without fuel. That's been beaten to smithereens lately. So we're going to need dinosaur juice. We're going to need defense stocks. We're going to need medical stocks. AbbVie in particular is another one that I own, but is a great choice right now because of immunology and all the work it's doing in those spaces.
Okay. Lindsay, let me bring you back into this conversation here, and I want to turn your attention back to the Federal Reserve. I'm looking now, the market's pricing in a 53% chance that the Fed hikes another 25 basis points next month when they meet, and then I guess a cut is expected sometime this summer. Where do you stand? Why is it always the guessing game?
Well, I think the market is overly optimistic in terms of the timeline that the Fed will be able to control inflation. As we saw with this morning's report, as we just talked about, inflation is still more than double the Fed's preferred level, that target range of 2%. So it seems unlikely that just another 25 basis points is going to get us to that sufficiently restrictive level that the Fed has told us is needed in order to slay that inflation dragon that's been lurking around the corner for quite some time. So while the market is optimistic that we'll only see one more rate increase, if that, and then a cut to follow suit, I think it's going to be a lot more complicated for the Fed, likely having to raise rates still higher from here and potentially keep them at that higher level for longer if we see supply side issues continue to keep the inflation level elevated.
And in the process, they might break things, Keith, and arguably they already have. If you look at what's going on with some of these regional banks, right, and some of the bets that they made on the sharp rise in interest rates. And the other thing they might be breaking is the job market. Keith, we get the March jobs report 1 week from today.
Well, we do. And to Lindsay's point, you know, this is interesting because I think the Fed has been so far off the mark all the way along through this process. And Lindsay makes some absolutely spot-on points that I share. They are not going to be able to fix this as long as supply chain and other issues go. The job market in particular is going to be a thorn in their side because companies are still growing, they're still expanding, they're just changing the composition of that labor force. So I think the number that we're going to affect, the top line number, is misleading. There's still lots of growth, it's just not in areas that people have traditionally expected.
We're just getting comments now from the New York Fed president, Mr. John Williams, and he's saying these stresses in the banking system will likely lead to tightening credit situations going forward. And, you know, I'm looking at this major rally that we have on our hands today. The Dow is up 305 points, just 10 points away from the highs of the session. The NASDAQ is surging by 1.5%, 171 points. That is a new high of the session. And then you see comments from a Fed official. And, you know, Lindsay, you say, well, what gives? How is the market maybe not responding to what our regulators are seeing and saying?
Well, I think there's some confusion about the level of policy firming needed if, in fact, we do see the recent volatility in the market translate into a significantly tighter level of credit. And so if we see organic conditions change in the credit market and do maybe 50 basis points, 75 basis points of the Fed's work, then maybe we don't need to raise the nominal level on the Fed funds rate quite as high as previously expected, but still getting that outcome of total firming up near 6% or higher, that level needed to quell inflation. But I think there is some misunderstanding or lack of communication between the market and the Fed with exactly how high they're going to need to raise rates in order to get inflation under control and continue to convince the market that inflation supersedes concerns about market volatility at this point.
And you agree with that, Keith?
Well, personally, I think they should take away the microphone from everybody but the chairman. But yes, I do agree with Lindsay.
Yeah. I'll let you wrap this up, Keith. Final thoughts on the market as we enter the new month and the new quarter next week?
The worst mistake an investor can make is to underestimate the future. Pay attention, look for the names that matter, and hold your nose and wade in.
All right. Keith Fitz-Gerald, Lindsay Piegza, happy weekend. Thank you for the time.
Hi, it's Keith here. Thanks for checking out today's highlight clip. What'd you think? Did I make sense? Is there something you'd like to add? Make sure you leave a comment down below, and of course, click subscribe to keep up right here on YouTube, or sign up for the email newsletter at the link below. You can also find me on Twitter and Instagram for my real-time thoughts on markets, analysis, and a whole lot more.